Here's a bold statement. The economic world is holding its breath as Wall Street and the Federal Reserve brace for critical updates on how President Trump's tariffs are really impacting inflation. But here's where it gets controversial. While the data so far hasn't shown a sharp inflation spike, businesses are quietly absorbing higher costs, and consumers are feeling the pinch in subtle ways. Are we seeing the calm before the storm, or is this the new normal? Let's dive in. On Sunday evening, markets hinted at another rally, with investors eagerly awaiting fresh economic data that could shed light on the true effects of Trump's tariffs. Stocks ended the previous week on a high note. The Nasdaq hit a new closing record, and the S&P 500 inched closer to reclaiming its all-time high. Futures tied to the Dow Jones Industrial Average climbed 68 points, 0.15%. S&P 500 futures rose 0.13%. And Nasdaq futures added 0.09%. And this is the part most people miss. These gains come despite lingering uncertainty about how tariffs will ripple through the economy. Meanwhile, the 10-year Treasury yield held steady at 4.285%, following last week's plunge fueled by growing expectations of Fed rate cuts. The U.S. dollar dipped 0.02% against the euro, but edged up 0.02% against the yen. Gold, however, took a hit, falling 0.93% to $3,458.90 per ounce, as markets await clarity on how Swiss gold will be affected by tariffs. Oil prices also slipped, with U.S. crude dropping 0.39% to $63.63 per barrel, and Brent crude falling 0.32% to $66.38. So far, Trump's tariffs haven't triggered the inflation surge many feared. In fact, inflation has consistently come in below forecasts for months. But here's the catch. Businesses have been drawing down stockpiles built up before the tariffs took effect, meaning new inventory is pricier. Here's the controversial question. Are companies shielding consumers from higher costs, or are they simply delaying the inevitable? Second quarter earnings reports suggest some firms are absorbing significant added expenses rather than passing them on, as consumers already face pressure from a slowing economy and hiring market. The Federal Reserve, meanwhile, has paused rate cuts, waiting to see how tariffs are influencing inflation and whether they're shifting consumers' long-term expectations. The Consumer Price Index, CPI, for July, due Tuesday, is expected to show a 0.2% monthly increase overall and a 0.3% rise in core CPI. Year over year, prices are forecast to accelerate to 2.8% growth from June's 2.7% in the headline rate, and to 3.1% from 2.9% in the core rate. The Producer Price Index, PPI, out Thursday, is projected to rise 0.2% monthly in the headline figure and 0.3% in the core. Adding to the intrigue, several Fed officials are scheduled to speak this week, just as the central bank welcomes Stephen Moran as a new governor, a move seen as tilting the Fed further toward a dovish stance. But here's the real debate. Despite the White House's attacks on the Fed, Trump's demands for lower rates, and the recent firing of the Bureau of Labor Statistics head, Wall Street remains surprisingly optimistic about stocks. Why? Analysts like Morgan Stanley's Mike Wilson argue that a new bull market has begun, with Wilson previously predicting the S&P 500 could hit 7,200 by mid-2026. This optimism is echoed by others, including Oppenheimer's John Stoltzfus, who raised his S&P 500 target for this year to 7,100 from 5,950, citing easing trade tensions as several deals are signed. So, what do you think? Are we on the cusp of sustained growth, or are we underestimating the long-term impact of tariffs? Let us know in the comments. This is one conversation you won't want to miss.